Thank you for joining us today. I'm Alan House. I'm an analyst here at Value Line. Two other senior analysts, Nathaniel Ekman and Charles Moran, join me today. Today, we're going to provide an update on the economy and stock market. We will then recommend one stock to buy right now, and finally, answer any questions that you may have. Please note that this presentation will be available on our website. That's www.valueline.com. and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those of us joining for the first time, I want to provide a brief overview of who we are here at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any other company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. Value Line's economic staff prepared this content. The nation added an estimated 206,000 jobs in June. That tally pushed estimated non-farm payroll creation above 1.33 million for the first half of the year. However, a closer look raised some concerns, the biggest of which was the continued uptick in the unemployment rate, now at 4.1%. The report also included sharp downward revisions to the April and May totals. The June jobs data was still another quote-unquote Goldilocks report for Wall Street. That is because the job creation figure was high enough to keep the soft landing scenario for the U.S. economy in place, even with some weakness seen in other parts of the economy. The decrease in the rate of average hourly wage growth over the last 12 months suggests inflation in the labor market is slowing. This raised sentiment that the Federal Reserve may begin reducing the federal funds rate by a quarter point, perhaps as early as the September Federal Open Market Committee meeting. However, Wall Street has been wrong on a few occasions recently in predicting when the Fed will pivot. The lead bank is walking a tightrope on monetary policy. Its goal is to bring the pace of price growth closer to the bank's targeted rate of 2%. But it must guard against pushing the economy into a recession to accomplish this task. On point, the Institute for Supply Management reported that manufacturing and non-manufacturing service activities both contracted in June. This is noteworthy as the service sector has been a key contributor to the recent gross domestic product expansion. Meanwhile, second quarter earnings season is heating up. Entering the reporting season, the Wall Street consensus was estimating average profit growth of roughly 9% for the S&P 500 companies. This would mark the highest year-over-year earnings growth in more than 2 years, and that expansion may be needed to justify the index's current high price-to-earnings multiple. In conclusion, stocks continue to move higher on an expectation of strong corporate earnings growth and hope that the Federal Reserve will begin cutting interest rates before year's end. On that note, Value Line provides a great deal of financial information analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line offers a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. I will now show you how to access those reports. Once signed in on the website, head to the dashboard where I'm currently located. This is the main landing page for subscribers. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Due to the challenging structure of the company balance sheets, Value Line is reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes. Alan's having some technical difficulties, so I guess I'll pick up the show. Hi, I'm Nathaniel Ekman. I'm an analyst at Value Line. Let's get back into it. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information about our proprietary ranks and ratings, Value Line provides a user guide that can be accessed by the investment education section of our website, right on the top bar there. Alan, are you back with us?
Oh, yes. Can you hear me?
Yes. You want to take back over?
Yeah, sure.
All right.
As noted in our economic analysis, the current environment is one of lingering uncertainty, but also potential. As such, we'll be looking for well-balanced companies with strong 18-month return potential. We'll start the screening process by looking at the safety rank. There are many risk measures to consider, but today we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investments education system section of our website. We are going to focus on stocks with a safety rank of 2 or better. By applying that first criterion, we have trimmed away our potential candidates from 5,200 down to 403. Next, we're going to filter for timeliness, one of our tried and true measures. Timeliness is a proprietary Value Line metric that evaluates the stock's projected price performance in the coming 6 to 12 months. Like safety, it is a straightforward scale from 1 to 5, with 1 being the highest. Today, we want a stock that will keep pace with the overall market over the short term, so we are looking at stocks ranked 2 or better. By applying this screen,
we have trimmed our list down to 69 candidates. We will now turn our attention to the technical rank. The technical rank is calculated by analyzing stocks' price trends over the past year and comparing them to the relative price changes over the next 3 to 6 months. Finally, recommends using the technical rank in conjunction with the timeliness rank. After applying this filter, our list is down to 51 possibilities. The 1,700 companies in the Value Line Investment Survey have a financial strength rating with ratings ranging from A++ for the most financially stable firms to C for companies that are in serious financial difficulty. There are a number of key factors that determine the financial strength ratings of a corporation. So we're going to look at for companies A+ or better. After applying this filter, we are down to 13 selections. Finally, we're going to look at price appreciation potential over the intermediate term. Today, we'll be looking at stocks with appreciation potential of at least 15% to the midpoint of their 18-month target price range. By applying this criterion, we have cut the list down to our final 6 stocks. You can make a strong argument for any of the remaining candidates, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now. And after consulting with a number of senior analysts, we prefer and recommend Goldman Sachs. Ticker symbol is GS. Before I click on Goldman Sachs, please note that screens can be saved and revisited by utilizing the created save screen button at the top. Let us look at the last full-page report on Goldman Sachs. Goldman Sachs is a global investment banking, securities trading, and investment management firm that provides a wide range of financial services to clients. Services include investment banking, trading, financing, advisory, wealth management, and asset management. As you can see by the historical array, which is in the middle of the page, the company has generally been a very strong performer over the past decade. Goldman Sachs posted solid earnings for the second quarter of 2024. Earnings clocked in at $8.62 a share, which is considerably higher than the $3.08 reported for the same period in the previous year and markedly above the consensus estimate of $8.40. Revenue received a boost from year-over-year growth in the global banking and market segment and the asset and wealth management segment, rising 14% and 27% respectively. Within the global banking and markets segment, investment banking fees increased 21%, driven by top-line gains in debt underwriting, equity underwriting, and advisory. Gains in equity investments contributed to the strong performance in the asset and wealth management segment. What's more, assets under supervision rose to a record $2.93 trillion. Looking towards the rest of this year and 2025, we believe that the company would benefit if the Federal Reserve cuts interest rates. This would be particularly beneficial to the investment banking division. Now we think the central bank will cut rates at least once this year, with the multiple cuts probable in 2025. Of course, incoming economic data bears close watching and could cause us to adjust our expectations. Goldman's balance sheet is strong with financial ratios that are above the industry average. We believe continued healthy profits will further bolster the balance sheet in the coming years. Overall, we think that Goldman Sachs is likely to hold up well in 2024 with healthy price appreciation potential over the 18 months ahead. It is today's one stock to buy right now. We will now tackle questions. Please note that we typically cannot answer complex questions about specific stocks on the spot. For this, we recommend a review of our latest reports. The first few questions were submitted prior to the presentation. Now we'll hand off to Nathaniel and Charles.
Thanks, Alan. I've got a question here from Nigel asking about a decrease in the value of NVIDIA stock. Now, like Alan said, we can't talk in too much detail about specific companies on this call. However, I can talk a little bit about the AI landscape more broadly and how that might affect companies in that space. Um, Looking ahead, AI is definitely here to stay, right? Like this is a very big development technologically. However, the pace of that progress may not match some of the current expectations that the market is setting. A comparison I would draw here would actually be the dot-com bubble of the 90s, where like the internet was obviously a huge deal, right? It changed everything about the world. However, when it came along and it was so obviously revolutionary, people expected that that change would happen overnight. And it wasn't quite overnight. It took time. And some of the companies that were with us in the 90s and were big in the 90s, like Amazon, are still with us and are even bigger now. But others, not so much. Now, I'm not saying that any potential correction with AI is necessarily going to be quite that dramatic. Um, you know, it's not a one-to-one thing, but I think it is a useful model for understanding how people are thinking about AI right now and how they might be incorrect in their anticipations about the timeline with this technology, even though the actual impact of the technology is in fact likely to be huge. So I hope that that answers your question a little.
Thank you. Thank you, Nathaniel. I also have a question here from another viewer. They said exactly how do lower rates benefit Goldman Sachs? And lower interest rates typically lead to an increase in borrowing by both companies and consumers. This can result in higher loan volumes for the company, boosting their revenue from interest and fees associated with these loans. The low rates can also lead to a rise in mortgage applications and refinancing activity in some cases. Reduced interest rates can make bonds and other fixed income securities less attractive, leading investors to seek higher returns in equity markets. This can boost trading volumes and investment banking activities such as underwriting and advisory services. Assets under management would also likely increase during a period of reduced interest rates, boosting management fees. Lower interest rates can also lead to an increase in M&A activity, which leads to increased advisory fees for Goldman. Demand for advisory services might well also increase as clients seek strategies to enhance returns in a lower rate environment. Corporate bond issuance is also likely to increase as it reduces a company's cost of capital. This leads to greater underwriting profits for Goldman. So in summary, despite a likely lower net interest margin, which is the difference between the interest earned on loans and the interest paid on deposits during a low interest rate environment, the overall impact on Goldman Sachs is generally positive due to the diversity of its revenue streams.
I also received a question from Joseph. He asked about the relative price earnings ratio that you can see on the Goldman report there in the middle, and the whether that is relative to the industry itself or the benchmark as a whole or some other S&P like index. And the answer to that is that it is a relative PE ratio that is relative to the value line universe. Right now, the value line universe PE ratio is 17.7. And if you look at the array in the Goldman Sachs report that we have shown, you can see that it has consistently traded at a discount, and that is relative to the value line universe as a whole. Unfortunately, we cannot make comparisons to other companies within an industry because the composition of some of the money center banks, such as JP Morgan, and Morgan Stanley and others that you might associate with Goldman Sachs, the composition of their businesses are different. For instance, someone like Citigroup has international exposure that is greater than that of Goldman, and Wells Fargo, another money center bank, has a composition of its business that is greater on lending and domestic housing market. So that is the reason why it's difficult to make a comparison to other companies within the large mega bank or money center bank industry.
Okay, thank you, Charlie. I also have another question here. It says, could you please describe the timeless ranking system in more detail? Certainly. The value timeless rank measures predictive relative price performance of the approximately 1,700 stocks during the next 6 to 12 months on an easy to understand scale from 1 highest to 5 lowest. Components of the timeliness rank include such items as the trend of relative earnings and prices and earning surprises. All data are actual and known. A computer program combines these elements into a forecast of the price change of each stock relative to all of the approximately 1,700 stocks for the 6 to 12 months ahead. Okay, and subscribers should focus on companies that are ranked at least 3 or better for timeliness. We update our timeliness ranks weekly, so investors should pay close attention to stocks they are interested in. So we're going to now show you how to access the weekly rank changes. Nate, if you would go to the dashboard, please. So once you're at the dashboard, you click on Investment Survey under Traditional Access. And then on the left, there's a headline for rank changes. And as you can see, each week we have rank changes. We have ranks moving up, ranks moving down. Nate, if you could click on ranks moving up or down for this week. Yeah, you could see that there's several stocks that have changed ranks over the past week. So if you're following a particular stock, it definitely is beneficial to check this out every week to see if the stock has gone up or down in timeliness. So it's definitely a tool that is, worth using. Thank you.